Well, it was an eventful week to say the least. We saw that divergence we've been talking about on the channel, that it is a stock picker's market and you need to be careful. We had Tesla that reported earnings that were pretty disappointing to say the least, while GM actually surprised to the upside. You had companies like Google absolutely crush it, but then you had questions with Meta and IBM. And Apple's kind of been stagnant in all this. And with all these stock market moves taking place, there is some macro things happening here that I just want to point out. GDP growth slowed to 1.6% in the first quarter, which is well below expectations. Now, if you're not thinking GDP is important, in my opinion, we need strong GDP with the government spending that's been taking place. The only way to kind of get above the deficits that we're running is to actually have very strong growth. We have to kind of outgrow our debt, if you will. Along with that, obviously, interest rates coming down would be extremely helpful. A healthy GDP is anywhere between 2 to 3%. We definitely fell below that healthy trend line of 1.8 to 2%. Experts were projecting 2.4%, but I feel like anything around 2% would have been absolutely fine here. This 1.6% GDP is a problem to me, and let me explain. Now, when we think about stagflation, what exactly is stagflation? Stagflation is when the economy sees weaker growth while inflation is running hot, and that's exactly what is taking place in this current situation. We've seen a tick up in the PCE, what the Feds like to go off of for inflation readings, which came in at 3.4%, and that is the biggest gain in over a year. So not only are we seeing GDP coming down, but we're seeing inflation, and the key metric of inflation that the Feds like to use, personal consumption expenditures or PCE, actually pop back up to a one-year high, which is starting to fall in lines of possible stagflation here. And when we look at the trend of GDP here, it's not painting a pretty story when we factor in how much fiscal spending is taking place. We've basically seen over 2% GDP, had a huge pop in Q3 of 2023, a 4.8% GDP coming down, which is obviously something we needed to see, to roughly 3.4%. And then we had a pretty significant fall down here of 1.59% GDP, call it 1.6% GDP, while inflation actually ticked up. Now, while we have inflation ticking up and growth slowing down, total expenditures in 2023 was over $6.6 trillion. But when we look at total receipts coming down, this is a recipe for disaster. We're getting a widening of government spending versus actual tax collection here. And with interest rates now higher and slower growth, when you have this kind of fiscal spending, you should be seeing GDP actually accelerating. And the fact that we're not, but spending hasn't slowed down, is turning into be a big problem here, because if there's less tax money to collect, but government spending keeps going up, and the cost of that government spending is getting more expensive, then there is a big gap here on how the government's going to pay its bills, keep issuing more and more debt, which is going to be a problem for yields. Now, oddly enough, the market kind of discounted a lot of this data that was hitting because, well, Google had really good earnings, and it kind of brushed under the rug the macro events that were happening, the more longer term events that I think are going to impact the overall economy here. We're seeing GDP coming down consecutive quarters while we get a one-year high in PCE. And we topple that with the government spending and lack of tax collection taking place, which is going to widen this deficit more and more, and even faster now that interest rates are higher because the cost of that debt is now going up. And when we look at the government spending, net interest on our debt is at the top of the list, with 13% of our budgeting now being paid to interest. This is wild to see because we obviously know the government's going to keep spending, but now they're spending on both ends. They're not only spending by passing these ridiculous bills, but they're also spending because their net interest on the debt is one of the most expensive things on their balance sheet. So in the face of all this, we're starting to see the 10-year now creeping up here, going above 4.5%. And this is where I drew the line in the sand. And this is where we start noticing stocks respecting the 10-year treasury. Once that 10-year treasury starts breaking above 4.5%, starts approaching 4.75 to 5%, is where we start seeing stocks really backing up and respecting the 10-year treasury. We have to discount future cash flows. Companies that refinance debt, their expenses are going to go up. The number one purchaser of U.S. debt was the Federal Reserve, which is now unwinding that pretty massive balance sheet, going from nearly $9 trillion to $7.4 trillion on their balance sheet here. So with that 10-year now spiking up, we can see the drastic move it's had on the yield curve, closing the gap from 100 basis points down to 29 basis points before the yield curve is uninverted. And as we've seen through history, guys, this is kind of where we need to be concerned, is the unwinding of the balance sheet and the unwinding of this yield curve when we get rates now normalizing here. Every time we have rates normalize, it's usually a ticking time bomb before recession. Now, here's the crazy thing. If you've been following the channel, you guys know I thought earnings were going to deteriorate as the year progresses. But I'm actually starting to see that earnings are a wild card story right now. We have some companies hitting, a lot of companies missing, but the weighted average of these indexes is not being impacted as much because the heavier weight tech companies are actually still performing well. But I'm just not seeing that earnings growth that the market is projecting out. So which means that the multiple on this market is extremely high when you factor out a full year of earnings deteriorating throughout the next 12 months. And that's what I believe is going to happen. My thesis has been that we get into 2025 and this is where things are going to get a little bit crazy. I said that the market could hit new highs. I still think that's going to be the case. But while the market's hitting new highs, we're starting to see some things crack and fold here. GDP being number one, PCE staying hot, number two, the unwinding of the yield curve, number three, the Fed's now not being able to buy assets, four, and government spending, which is probably going to be the biggest problem by the end of this year, and financing the government debt as well. So when you think about all these things that are on the table, and we're at a peak labor market, which means that I believe that the labor market's at a peak, and most likely the labor market, we're going to see unemployment start ticking up, because I do think it's coming from, the labor market has remained strong for an extended period of time, but as these interest rates remain elevated for longer, we're going to start seeing more and more things break. So now we have to see if the trends stay intact. So the trend of GDP, is GDP still heading in a downward direction as we saw the last consecutive 3 quarters, it's trending down while PCE is trending up. So now it's all about the trend. And then the trend of unemployment. We did tick up on unemployment. We went from 3.6 to 3.9, sitting at 3.8. But the also key metric we have to look at is hours worked. Hours worked are actually coming down, and that's another trend that we have to follow here. If that hours worked still keeps coming down while all this is taking place, it definitely seems like we're heading into some sort of slowdown and or turmoil here. And I even think you can say stagflation if GDP stays low while inflation is still ticking back up. As always, appreciate your time, and we will see you in the next one.